I mean, really, options, right, historically have grown out of futures trading. It's at some point you saw that this is back in the Middle Ages even that people started to offer or started to ask for a premium feature to a future, which was the right to not have to take delivery. And so a simple way to think about it then is that an option is sort of a future with a premium stop loss order. It's one that is rechargeable and for a certain period of time. And the fact then that you have this asymmetric um, uh, payoff structure, this true convexity, it means that it's the same kinds of trades as with perpetuals, but now instead of volatility being short volatility, you're sort of long volatility.
Welcome back to another episode of Bitfinex Talks. I'm your host, Ricardo Martinez. Today, I am very privileged to be joined by Hendrik Ghys, who is the CEO of Thalex. Thalex recently had a integration with Bitfinex Derivatives, and you can now trade options on Thalex from directly within your Bitfinex account if you're a verified Bitfinex Derivatives customer. Hendrik, how are you today?
Hey, Ricardo, doing well. And you?
Doing excellent. Thank you. I'm happy to have you on the show. I'm excited to hear about the Thalex and Bitfinex Derivatives integration. To kick off the interview, my first question is, what inspired you to start Thalex?
Yeah, so Thalex was actually started by a group of market makers that were active in crypto for many years and were active in both futures and options market making. And so really the genesis of the Thalex idea was traders that said, there's this problem we need to solve. We need more alternatives to Deribit to ultimately grow the option space. And it was more a case of me being inspired to join that founding team around that product idea. My background is actually from the investment side. I got into crypto working for a fund that managed the wealth of an entrepreneur, and so we were investing with a lot of degrees of freedom. That meant we bought coins back in 2016, and in 2017 we started actually looking at exchange investments, and most notably we acquired Bitstamp in 2018. And that was a deal that I led and subsequently spent a lot of time inside the company in doing the post acquisition and of course being a board member and figuring out strategy. And so the main problem, right, that a spot exchange like Bitstamp has faced is that after 2017, the demand for the use case of trading actually has shifted increasingly towards derivatives. And so the spot exchanges are used for ramping, for the occasional swing trades, but most of the trading is happening increasingly in derivatives. And so the idea there that we were exploring within Bitstamp was, what if you could partner on derivatives instead of having to build it yourself? And when I joined Thalex, and was talking to the founding team and we're trying to figure out a commercial strategy, we immediately realized, well, it's kind of challenging to just do direct customer acquisition because you have a relatively small customer base that's actually going to be addressable within options from day one. Right? It's a relatively niche market still. We all agree it's going to be huge one day, but I would say that the number of, for instance, retail traders that are doing options today is relatively small still. And so how are you going to actually attract takers? And this idea from Bitstamp, where we looked at derivatives partners, really couldn't find them. I saw in Thalex the opportunity to solve effectively the other side of the equation and create a distribution model where beyond just people being able to onboard directly on Thalex, we would also partner with exchanges and do essentially a win-win situation where we offer derivatives that are very hard to build, and we offer them in a fast timeline. They get basically an option on our options product, and we get in turn we get access to a large existing customer base, and we get an option on their customer flows. And then we just share the wealth via a revenue share. And that's a model where it makes, of course, sense from the exchange's perspective. then the question becomes, how do you make the users benefit? And that's where we just want to remove the friction to go from one exchange to the other. So that means simplified onboarding, that means free transfers, and an integrated trading experience. And so really that was sort of the inspiration behind Thalex, is sort of this product idea of how do you build an alternative to Deribit, how do you build a new and better options exchange, married with a distribution model that is scalable and can solve the hard question of finding the takers once you do everything else.
Hendrik, for those that don't know, I guess how would you explain the difference between options and traditional perpetual swaps and futures, which we've seen in the crypto market already?
Yeah. So the interesting question, of course, is that options are in a way a much more traditional product than perpetuals. But it's absolutely true that most traders within crypto are more familiar with perpetuals trading. So I'd say the key difference, right, in how these different instruments play out is that with a perpetual, you effectively it's effectively a special form of a future in a way, right? It's a future that doesn't expire, but similar to a future, it's an exposure to one Bitcoin. And so from that perspective, it's a fairly symmetrical contract, right? If you go long a perpetual and Bitcoin goes up by $1, the contract goes up roughly by $1, and the same on the downside. Now, of course, most people trade perpetuals with some form of leverage, right? Either through explicitly a leverage multiplier or implicitly by putting a stop loss. And from that perspective, perpetuals have the same challenge as you have with traditional futures, is that you are in a way short volatility, right? So any convexity that you hope to obtain with a trade, i.e. asymmetric upside versus downside, really is being paid for by the probability and the inconvenience of potentially being stopped out. And what essentially an option is, what you could think of an option doing is providing an exposure to that asymmetric payoff structure that you like, but doing so in a way that you have a premium stop loss, a stop loss that doesn't kill the trade once it gets hit, but is sort of rechargeable. And this is essentially something that benefits from volatility rather than volatility working against it. I mean, really, options, right, historically have grown out of futures trading. It's at some point you saw that this is back in the Middle Ages even, that people started to offer or started to ask for a premium feature to a future, which was the right to not have to take delivery. And so a simple way to think about it then is that an option is sort of a future with a premium stop loss order. It's one that is rechargeable and for a certain period of time. And the fact then that you have this asymmetric payoff structure, this true convexity, it means that it's the same kinds of trades as with perpetuals, but now instead of volatility being short volatility, you're sort of long volatility.
Okay, thank you for that detailed explanation. How would you describe Thalex as being different from existing options platforms that are out there?
Yeah, I think Thalex is in many ways similar to the market leader Deribit. We offer a similar set of contracts, perpetuals, futures, options, similar strikes and maturities. But I would say the difference there is in details. So we have actually funny detail is that most of the options contract traded today are still in the form of inverse contracts. Which is the legacy of the inverse perpetuals and basically Deribit introducing those, having adopting that solution for options as well, and ultimately scaling that, right? And so you see the power of liquidity path dependency. But if you would design an option market today, you would go for the simpler solution, which is a linear contract that is stablecoin settled. And that's exactly what we have for all of our contracts, including options. And then I would say, yeah, the details options are about getting details right. So it's about getting the performance right. Like you have hundreds of different order books that all need to be sort of synchronized and have support order execution all at the same time. So you need to be very focused on latency, on fast order checks. The other thing is you need good delta hedging infrastructure. So you need good liquidity in perpetuals and futures to support delta hedging of options. The ideal hedge of an option is actually with the future of the same expiration. Now, people tend to use perpetuals because they're the more liquid instrument. There's more volume traded, but there's risks involved with that, right? So in a market like this one, where you have a steep rally and there's a lot of calls being bought, right? Market makers delta hedge that by buying perpetuals, and they end up being stuck in these positions where the funding rates start building up. And they have also the risk to manage at expiration, that when options expire, the perpetual continues to march forward. So futures are actually a more elegant hedge for an option. The problem then is, how do you get liquidity into them? And so what we have is, for instance, a system called implied matching, where we take the liquidity of the perpetual. We also have perpetual future spread books. And the liquidity in those spread books, we call them rolls, in combination with perpetual liquidity, can actually imply orders in the future. And ultimately, what should result from the interaction of these order books is that the liquidity of our perpetuals gets transported into the futures. And the taker demand in those futures ultimately even triggers execution of orders in the spread books and the perpetuals. And the long story short there is that the liquidity is effectively sort of multiplied between these order books, which ultimately also benefits the options liquidity. And so those are examples of details that we were able to focus on by sort of building an architecture that really was meant to optimize everything around the options. And the other example of that is that we have integrated RFQs. Right, options have naturally wider spreads, and there's a lot of demand in options for not just trading outright calls and puts, but to trade combinations. Call spreads, put spreads, straddles. These things are very popular. It's tedious if you, and it's even a little bit risky if you have to leg into those trades, i.e., buy all these contracts individually and then have the exposure not be what you want for a brief amount of time. So what we have is RFQs that support these combination orders with atomic execution and fee advantages. And those RFQs can also be used for block trades where liquidity in the screen is maybe not optimal. So all of these things combined, right, basically mean that with Thalex, you can express any trade you can think of, right? Options are more a bet on the shape of the distribution rather than just on whether Bitcoin or ETH goes up and down. And so it's through the combination of all these contracts that you can effectively express any view you can think of.
Options, I guess, in my opinion, are kind of like a relatively new development as far as crypto markets go. What kind of overall potential do you see for like the growth of options markets in the short-term future?
So I think that the options market is, if you look at volumes, it's still relatively small, right? It's only 3 to 4% on an average day. Perpetuals continue to be much larger. Having said that, it's also though an artifact of the fact that the perpetual trading on leading exchanges like Binance has very high velocity, right? So the turnover of volume to open interest is very high. If you look at the market share of options in terms of open interest, it's actually already 20 to 25% of the market. And interestingly enough, like Deribit is the largest exchange in terms of open interest. It has more open interest in its options contracts than Binance has in its perpetuals.
Wow.
So it's also like so option adoption is also a function of people basically taking positions with a longer time horizon than they typically do with perpetuals. So overall, I think that will come from a maturation of the trader community. That of course comes from institutional adoption. There's a lot of option trading firms that have started to become active in crypto, and many more that are entering. That's also helpful to increase the liquidity of options over time. And yeah, when you remove friction out of a market, you ultimately increase volume. So institutionalization is definitely a driver that can push options to a much larger share of the derivatives market. But I would also still say that I still believe that retail, everybody who trades a perpetual today is a potential trader of options tomorrow. It goes back to the answer to the previous question of the fundamental difference between options and perpetuals. It's, options are a way to be explicitly long volatility. And from that perspective, they are very complementary with perpetuals trading. And I think over time, just having options be more accessible, having our little experiment between Bitfinex Derivatives and Thalex, where it just becomes easy to try your first option trade. I think that in combination with education will ultimately also drive some conversion from the retail perpetual trading volume ultimately into options. And so overall, I think options will be one of the fastest growing segments in derivatives trading. And then the final vector, of course, is that whilst the volumes are currently focused on Bitcoin and ETH, I expect as of next year already that the material portion of the options volume will start to be seen in altcoins.
Okay, that's super interesting. My next question is, why do you think that options are seen as like a more difficult or sophisticated trade as far as crypto is concerned?
I think that's a misperception, to be honest.
Okay.
I think there's a mental difference between like a stop loss and a premium of an option, right? Where it always feels like the premium is spent and is sort of a sunk cost, whereas the stop loss is something that is more of a probabilistic cost, but it doesn't feel like a cost when you enter the trade. I think I think that's one aspect. I think another aspect is that it's easier to enter a trade in a perpetual because the perpetual abstracts away the choice of a time horizon, and it also abstracts away the cost of carry. Right? It's all sort of hidden. Ultimately, what happens with perpetuals is that you have the funding costs, and actually over time, right? Like you'll see that funding rates, the cumulative payment on funding rate for a certain time horizon, actually sort of converge with the premium that you have to pay with the future. But if you buy a future for a premium, right, that cost is more upfront. And options have the same thing, right? That cost is presented upfront. And with futures, you have to choose a time horizon. With options, you have to choose both a time horizon and a strike. So you have to plan the trade a little bit more. But once you're in the trade, especially when you're long an option, it's actually easier to manage, right? With a perpetual, you have all that path dependency. You have to manage your stop, and you have this chance of you being right on direction, but you know volatility picking up and ultimately being stopped out of a trade that was right in terms of like your view on the market. You just structured it badly. Whereas with call options, once you're in the trade, the job of a call option is to guarantee that if by the time it expires, right, you're in the case of a call option, your Bitcoin ends up higher than the strike, then the option guarantees that you get that payoff. And so effectively what happens is when you buy an option, you sort of transfer the path dependency of managing that position. You effectively transfer that to a market maker. And so you could argue that once you're in an options trade and you're not sort of like day trading it, right? But you're sort of more like this is more of a careful consideration of a certain price target over a certain time. It's actually easier to be in that trade. And so I think ultimately it's down to perception that is in part misperception. And like I said before, I think ultimately they're fundamentally complementary tools. And I would say the same goes for futures, right? Simply put, if you want to express a view that you think Bitcoin will go up, well, you can do it with a perp, and then you have a variable cost of carry in the form of funding. You can do exactly the same one delta Bitcoin exposure with the future, and then via the premium that you pay for that future, right? The premium is the difference of that price with the index. You effectively lock in your cost of carry. You sort of lock in the implied interest rate. And then with the call option, you sort of lock in the future trade, but you can choose the strike, and it becomes, from that perspective, a way to express a long view on Bitcoin that's also explicitly long volatility.
My next question is, why did you guys decide to partner with Bitfinex Derivatives rather than another exchange partner to launch Thalex?
Yeah, the Bitfinex derivatives discussions for us started early. We knew we wanted to partner with an exchange that had an interesting existing customer base. Also, what was interesting with Bitfinex derivatives is that they looked at building options themselves and knew like how hard it was. They also knew they basically also appreciate the distribution strategy and understood that ultimately it's a better product if you create one sort of big options liquidity pool that you can expand over multiple exchanges over time. Yeah, it's also like frankly the more entrepreneurial spirit of the Bitfinex derivatives team compared to some other exchanges where they were sort of happy to take the first mover risk, and hopefully that will also benefit them in the end.
Okay, cool. And then with the integration with Thalex and Bitfinex Derivatives, what does that mean for Bitfinex Derivatives customers?
So, well, first of all, it means that to onboard on Thalex, there's a lot of friction we can take away out of a traditional onboarding. So essentially, when you start the onboarding, you give consent to data being shared. And then a lot of the things involved in an onboarding, like uploading personal information, selfies, that process gets heavily simplified into essentially something that should take less than 30 seconds. And then as soon as you're verified, you'll have a dedicated Thalex page within Bitfinex where you can transfer assets from Bitfinex to Thalex and back. Which is free of charge. I mean, there's a daily limit, but for ordinary use, it's essentially free and it's fast. And then finally, the trading experience is also integrated. You don't have, let's say, separate account details for Thalex. All of that is done from within the Bitfinex interface, where you click a green button saying trade on Thalex, and then you'll be logged into a Thalex session. You'll trade on our UI. You'll have access to all our features. But essentially, a lot of that friction is removed, and it's sort of one integrated customer experience.
Before we started the interview, you were kind of explaining to me that you guys have an incentives program that you're launching along with the platform. Do you want to talk about that at all?
Yeah, absolutely. So what we're doing to essentially bootstrap both volume and liquidity is we have two programs that are combined a 500,000 USDT reward pool every month. We're going to run that for the next 6 months. Half of that is to incentivize liquidity. That's called MVP. That's called MQP, our market quality program. And there, essentially, what we do is we pay for every limit order that's in the book. We attribute a score of how much value that contributes to our liquidity as a whole, and that's essentially then rewarded directly even before the order is filled. And so that's been our mechanism of getting liquidity into the books without doing side deals with market makers, and instead having sort of an open competition for liquidity. And that's the way we've gotten the books full before the volume built up. So that's a pool of 250K per month, and that's open to anybody. So of course, institutional market makers are doing most of the work there, but we also have some retail users that have integrated via API that also have their own quotas and that are kind of competitive in this game. And then the other incentive for volume is called MVP. And essentially, the way that works is to think of the exchange as a network effect, right? Like if you pay fees to an exchange, in a way you're paying for the network effect of customers and orders that they were able to bring together. And you're kind of paying a fee so that you can lower your cost of trading, right? Because you have lower slippage, you have smaller spreads. And so our idea is basically to say, okay, the network effect on Thalex is a function of volume, and to stimulate the volume early on, we essentially have negative fees. We have volume rebates, and those volume rebates they're basically scaling inversely with volume. So the lower volume is the higher the rebate, and that's a way to essentially give essentially create sort of solve for an equation where when volumes are low, we essentially make up the difference for the cost of execution and fees. As volumes pick up, that incentive becomes smaller incrementally per trade. But overall, what it means is that regardless of the phase of the bootstrap, right, the combination of liquidity and the volume incentives mean that your total cost of executing a trade, fees, spread, slippage, should actually be competitive with the largest exchanges out there. And so again, it's all about like removing the friction to trade early on, and it just means that that you should have a good trading experience on Thalex even when our volumes are still below 100 million a day.
Right now, we've seen that Bitcoin hit some all-time highs. Last night, it's around 97,000, and the integration launched about a week ago, if I'm correct. What kind of response have you guys seen with this price action?
Yeah, so we've definitely seen the first onboardings coming in. I think there's a lot of interest initially for actually using our product for yield strategies. So basically, selling covered calls is interesting. Selling upside strikes hedged with Bitcoin, and then also doing the same thing with futures. So that's been definitely yeah, an interesting pattern with the Bitfinex crowd. It's sort of not completely unexpected because that's been the feedback as we were like building and testing the integration all along. Is that what the options component really does for a lot of Bitfinex derivatives customers is that it's a way for them to generate additional yield on Bitcoin and ETH. If you want to capture yield with the classical cash and carry with perpetuals, then of course the problem is that you're sort of also completely delta neutral flat on that. Whereas if you, for instance, think about like Bitcoin going up to 120K, you could sell a covered call there, and then still participate in that upside up to 120. So like a typical mental model that people use is that they sell the call option where they would otherwise take some profit on the run up anyways, and then they get paid to wait. Now, of course, that's sort of a simplifying way of thinking about it. You should always check that the risk premium you get for selling options is adequate, and you should also, of course, think about like the opportunity cost of any risk that you sell. But it is sort of a simple rule of thumb that you can use, and yeah, it's sort of reflective in the initial flows from your customer base.
Okay. And my final question is, what is the overall vision that you have for Thalex moving forward?
Well, the overall vision is it kind of harkens back to the strategy, right? It's to build an options exchange that is very scalable, and that means like removing all the friction. Options liquidity and volume is a function not just on the frictions in the options market, but also in the adjacent markets that are used for hedging. So our goal is ultimately to be very competitive on fees, and to maximize the volume we can get. And ultimately, the interesting thing, by the way, on fees is that it's not necessarily a commercial problem, right? It's also a technology problem. There's a lot of exchanges that could actually increase their volume and make more money on lower fees. But then the question is, can your systems handle it? So I would say the vision there is to be very competitive on fees and make sure that we scale on all of the different verticals. And then the other part is, of course, that ideally we want to go multi-exchange, right? We want to go to multiple exchange partners and keep on adding new takers to a centralized pool of liquidity. Right, our integrations are not just a product partnership; they're, I think, also a liquidity partnership. And the more traction we can then have, the more we can also then reinvest that into lower fees, into incentives to move volume to Thalex. And then I would say, yeah, the third angle is that currently we are limited to Bitcoin and ETH as underlyings, but I definitely see us also expanding to altcoin options.
Okay. Hendrik, thank you so much for coming on the show and talking to me about options trading and the Thalex Bitfinex Derivatives integration. The interview is coming to a close, but do you want to give out your website, your social media, and let people know how they can get started with Thalex?
Yeah, sure. So it's easy to find us on thalex.com. That's Thalex with TH at the beginning. You can also find us from within Bitfinex. There's a dedicated Thalex landing page, and you can also find us if you click in the derivatives trading dropdown. You also find Thalex there. And then on Twitter, we're at Thalex Global.
Okay. Thank you so much once again, Hendrik. It's been a pleasure talking to you about options trading today.
Absolutely, my pleasure.